Feedback is the breakfast for champions. You wouldn't drive a vehicle that doesn't have a dashboard to give you the vital information that you need. Why would you try to run a business blind? Today we are counting down the top 5 key performance indicators that you must track if you are the owner or leader of an enterprise. But before we start, let me offer you our 11-minute business diagnosis quiz. Take this quiz right now by clicking on the first link in the description below to find out how future-proof and stable your business is going to be over the next decade. KPI number 5, income statement and balance sheet. Often the most overlooked factors are the simplest. Income statement and balance sheets are the most fundamental financial tools you have as a business leader to grow your enterprise. Why? Because this is the first thing anyone will want to see before they give you money in order to grow. An income statement tells a lender how much debt you already have the capacity to service with your existing profits. A balance sheet gives them an overview of your business's stability based on the existing assets and liabilities that you have. Anyone serious about growing their business must have an eye on their income statement and balance sheet at all times. In fact, if you're serious about wealth accumulation, you'll also want to keep a hawkish eye on your personal income statement and balance sheet as well. Number 4, inventory turnover. Inventory turnover period is the number of days it takes from your purchasing inventory to liquidating it. Whether you follow a FIFO, which is first in, first out model of inventory management, or the FILO, which is first in, last out model, you need to minimize your inventory turnover period. Why? Well, firstly, you want to keep your inventory to a minimum while ensuring you always have enough stock on hand that operations aren't hampered. This reduces your warehousing requirements as well as other costs associated with managing inventory, like insurance. Obviously, you end up paying a higher premium to ensure a greater amount of inventory, right? Secondly, and this is a sneaky little secret I'm letting you in on, when we acquire a company, we look for companies with a high amount of inventory. Now, obviously, this is only applicable when inventory has a sufficiently large shelf life. Why? Because firstly, we can use inventory to leverage the buyout. Non-perishable inventory can be used as a collateral for lenders to finance part of the acquisition. And secondly, more importantly, post-acquisition, the simplest way to boost cash flow is to lower inventory turnover period. In other words, you can boost your cash flow by simply minimizing the inventory turnover period. Now, exactly how that works mathematically is a little bit beyond the scope of what we are discussing today, but we'll talk about it in some other video, some other day. If you have a larger corporation with dozens of products, you'll even want to track inventory turnover period for individual items or blocks of individual items. By the way, here at Westernston, we work with our clients not only to track these KPIs, but also to optimize them. If you'd like to discuss how we can help, click on the second link in the description below and contact us. We'd be happy to offer a complimentary consultation to qualifying businesses to explain how it all works. Moving on. Number 3, marketing break-even period. Now, we recently discussed all about marketing break-even period in a video. You can watch that video by clicking on this card right here. But basically, marketing break-even period is the amount of time it takes for you to gain as much profit from your newly acquired clients as the campaign itself cost. In other words, if you spend $10,000 on a campaign today, how long will it be before the newly acquired clients bring in $10,000 in bottom line, not top line? Depending upon what your profit margin is like, $10,000 in bottom line could mean anything between $10,000 and $200,000 in top line sales. The faster you break even on your marketing, the quicker your business grows. Your effective marketing budget is your deployed marketing budget multiplied by the number of break-even cycles you have in 1 year. For instance, if you deploy $10,000 for a marketing campaign and it takes 6 months for you to receive enough profit from the newly acquired clients through this campaign, your effective marketing budget for this client acquisition method is only $20,000 since you can only run it twice. But if the same campaign had a marketing break-even period of 1 month, you would be able to run it a dozen times and your effective marketing budget would be $120,000. Marketing break-even period is something almost no small or medium business leader tracks as deeply as they should. If you want to witness exponential growth in your business, however, you must track your marketing break-even period. KPI number 2. Top 20%, 5% and 1% clients by revenue and profit. Not all clients are equal. We've discussed this before in another video that you can watch by clicking on the card right here. But basically, it's the 80-20 principle compounded. So you know that 80% of your revenue comes from top 20% of your clients, 80% of your revenue or your profit. But even among those top 20%, the 80-20 rule still applies again. So of those top 20% clients, the topmost 20% bring in 80% of all of their revenue. In other words, the topmost 4% of your clients are likely to bring in 64% of all your revenue. And this can be further compounded, so less than 1% of your very best clients are likely to bring in over 50% of your revenue. So as far as key performance indicators go, you don't just want to track the average revenue per client because that's a rather meaningless metric. What's far more important is the average revenue or profit that is generated by your top 20% clients, your top 5% clients, and the topmost 1% of your clients. Are you already tracking all these KPIs? And finally, we're down to the number 1, cash flow. Cash flow to business is literally what blood is to body. Without cash, it's game over. No matter how profitable you are, cash flow is survival. Now, cash flow is misunderstood sometimes, so allow me to explain that. Cash flow is not gross profit. It's not EBITDA, earnings before interest, taxes, depreciation, and amortization. It's not even PAT, profits after taxes. Cash flow is much better understood as simply an account of actual cash inflows and outflows. In other words, the money you have in your account right now. Speaking of accounts, by the way, check out our video on the finance management framework for small businesses. It's a simple framework for business owners to have total control and clear visibility of their cash inflows and outflows. That brings us to the conclusion of this video. At Westernston, we work with a small number of qualified businesses to help them not only track these KPIs but also optimize each of them. If you'd like to explore the possibility of working together with Westernston, get in touch with us by clicking on the second link in the description below and we'll get back to you. Thanks for watching this video. Hit like if you gained one or more important insights from watching this and share it with your colleagues, your associates, your friends, whoever might benefit from it. And make sure to subscribe and hit that bell icon to be notified every time we put out a new video.